Here we are back with Tip Top Corp, producing 3,000 units of product that require 2.5 standard hours per unit. The standard fixed overhead cost per unit is 90 cents per hour at 8,000 units, which is 100% of normal capacity. So we asked you to determine the fixed factory overhead volume variance. So the fixed factory overhead volume variance takes standard hours for 100% of normal capacity, and for Tip Top, that was the 8,000 hours. And then we reduce that by the standard hours for actual units produced multiplied by fixed factory overhead rate. We do their 3,000 units multiplied by 2.5. So that's 7,500 hours. We take that difference of 500 hours and multiply it by 90 cents, and that gives us our $450 unfavorable variance. Rounding in to the end line here, when it comes to standards and variances, we talk about the reporting of the factory overhead variances. The total factory overhead cost variance is the sum of the variable factory overhead controllable and the fixed factory overhead volume. So in this case, it's a total of $1,600 of a favorable and variance. The favorable $4,000 controllable variance washed out all of the unfavorable fixed factory overhead variance, still netting us in a great position. In reporting, the factory overhead cost variance report is great for management to be able to control their factory overhead costs. The budgeted and actual costs for both elements, along with the related controllable and volume variances, are then reported by each cost element. So here we're looking at such a report. So we see direct materials, we see how much of it's attributable to powers and light, how much is attributable to indirect factory wages, and how this breaks down. By not knowing where or how, we can't effect change. The applied factory overhead for Western Rider for the 5,000 XL jeans produced in June is taken by taking the standard hours for actual units produced and multiplying them by their total factory overhead rate. As you'll recall, those two components, fixed and variable, to create total were $6. The total actual factory overhead rate, overhead for Western Rider, so what we actually experienced was 22,400. So then you'll notice that when we apply it this way, we can actually check our calculations and see that we really do have a true $1,600 favorable variance. Now, factory overhead is all based, the predetermined factory overhead rate is based off those estimates, those standard costs, those things we're expecting, and then life happens. So when life happens at the end of the period, so we're looking at the end of the year, our factory overhead account is going to usually have some kind of a balance in it. Now, if this is a debit balance in the factory overhead account, this means that we have underapplied our factory overhead. This usually occurs when our factory overhead costs exceeded the applied factory overhead. We experience some cost overruns. A credit balance in the factory overhead represents overapplied overhead. This happens when the overhead costs were less than the applied factory overhead. The difference between them is the total factory overhead cost variance. Thus, underapplied and overapplied factory overhead account variances will represent the following total factory overhead cost variances. Underapplied is from unfavorable. Overapplied is from favorable. Here we're showing you how that breaks down in a T account. So we had actual factory overhead experienced of 22,400 that debited into the factory overhead account. Now, as we were going through and using our predetermined overhead rate for 4,000 hours as expected, and $6 per hour, we applied 24,000. So we overapplied by 1,600. We have a credit balance in this account. So the 1,600 of overapplied factory overhead and the favorable total factory overhead costs are the same amount. So we compute these by comparing the factory overhead account with the budgeted total overhead for an actual level that was produced. The variable factory overhead controllable variance is the difference between actual overhead incurred and the budgeted overhead. Now remember, the budgeted overhead is how we determine our predetermined factory overhead rate. This is what we use in applications. If the factory overhead exceeds or is less than the budgeted factory overhead, this controllable variance is considered unfavorable. If it's less than, it's considered favorable. This is the difference between the amount that we applied and the amount we budgeted. If the applied factory overhead is less than the budgeted factory overhead, it is considered unfavorable, and the flip side, likewise. Here's a cute little graphic for you to see how they all break down when it comes to factory overhead. Because first we have the actual, what occurred, then we have the application, which is based off those budgets. How is that budgeted determined? What are the variances? Are they controllable? Are they volume? What are they comprised of? Excuse me. Your standard costs that you use. They're a management tool to control your costs separately from the accounts in the general ledger. Now, keep in mind with management accounting, a lot of what we look at and we compare to never actually appear in the official accounting records. So these are all supplemental reports, supplemental records that allow us to perform, to operate, to create those financial statements. However, a lot of companies might include those standards in their accounts. One way that they do this is that they record their sustained costs and variances at the same time that those actual product costs are recorded. So let's look at Western Riders. They purchased on account 7,300 yards of denim at $5.50 a yard. They were expecting $5 per square yard. So, how they recorded it at that time was that they increased their materials by 36,500, and then they also debited a direct materials price variance account for $3,650. A debit balance in a direct materials price variance account represents an unfavorable variance, whereas a credit would be a favorable variance. Then, as production was going on, and they used 7,300 square yards to produce the 5,000 pairs, the standard quantity of denim should have been 7,500 square yards at a standard price of $5 per square yard. So they go ahead and recognize the 37,500 in work in process. This is based off the standard, right? This is 7,500 square yards multiplied by the $5. We actually use 7,300. So we reduce our materials only by what we actually used. So that's the 36.5. And we recognize the 1,000 to direct materials quantity variance. Now, a credit balance in this is a favorable, whereas a debit balance would be unfavorable. We'll go ahead and move forward past this. I want you to come back and practice this, but here are the answers. So, journal entries that record standard costs and variances for direct labor are a lot like those that we use for direct materials. And they're summarized in this same way. Work in process is debited for the standard cost of the direct labor. Wages payable is credited for the actual direct labor costs incurred. Depending upon where you need a debit or a credit, is how you will determine. Remember, for all debits, we have equal credits. The direct labor rate variance will be debited when there is an unfavorable variance and credited for a favorable variance. And then the direct labor time variance could be debited for an unfavorable variance and credited for a favorable variance. Now, keep in mind, this is just one method. Many times, this type of information is not actually in the accounting records. Here we have the recording for and reporting of variances in the accounting records for factory overhead. So your factory overhead account already incorporates those standard costs and variances into their journal entries. Your factory overhead will be debited for all the actual factory overhead and credited for that applied or that standard factory overhead. The ending balance is the total factory overhead cost variance, whether it was over applied or under applied. You'll go and compare the actual factory overhead with the budgeted factory overhead and determine what the controllable variance is. By comparing the budgeted factory overhead and the applied factory overhead, you will also determine whether it's a volume variance and what that is. When goods are completed, your finished goods is debited and your work in process is credited using the standard costs for the product that is transferred. Now, at the end of the period, the balances of each of the variance accounts, when we use them, is going to indicate the net favorable or unfavorable variance for the period, much like the factory overhead account will reflect that. Those can be reported in the income statement that's prepared for management's use. You would not want to publish this information. So here is an income statement that is showing the basic information in the far right-hand corner. As you can see, we have a total factory overhead volume based off of 3,550 unfavorable that would result in a reduction to our gross profit of 38,950. This particular report that you're looking at here would only be given to managers. It would not be given to the general public. Never report those types of variances to your external users. When you're creating the income statement for them, the balances of those accounts then are transferred to your costs of goods sold. However, in the event that you have something that is significant, or if many of the products that were manufactured are still in inventory, those variances will be allocated accordingly to your work in process, your finished goods, and your cost of goods sold in pro rata shares. This allocation is going to convert these account balances from standard cost to actual costs. I want you, after the end of this lesson, to go ahead and prepare this income statement with the variances. Here's the basic information. You can hit pause and create it now, or you can create it afterwards and then compare to the solution. This is a basic income statement through gross profit that's going to show the variances and how they break down. Now, we spend a lot of time talking about financial measures because we provide that measurability in accounting. However, there are non financial performance measures that can be expressing performance in a measure other than dollars. These are used to evaluate time, quality, quantity, efficiency, things of this nature in relation to your business activity. Some of those are your inventory turnover. You've seen that particular ratio before. You might have a percent on time delivery. This is information that you would gather based off production and production time or delivery time or time from the point of order to the point of delivery. That point of order to the point of delivery is your elapsed time. You're going to have metrics. You're going to have standards of when you expect these things to occur. You might engage in surveys and determine your customer preference rankings for yourself compared to your competitors. Response times to service calls, response to emails. What is the time to develop new products? How long does it take us to go through research and development? Employee satisfaction, customer complaints, customer kudos. There's a whole host of non financial performance measures that are utilized by organizations in order to determine if they are efficiently and effectively engaging in their activities. These can be linked to a variety of inputs or outputs of any activity or process. A process is defined as a sequence of events for performing a particular task. Things don't just happen overnight. We have to do things in order for them to happen. So inputs come in to the activity or process to create our outputs. So inputs, how many employees do you have? How experienced are they? How much training? Um, I love the fryer reliability for the fast food restaurant. What kind of new items do we have? What kind of fountain drinks do we have available? These are all the different things that come into a fast food restaurant. Basically, your activity is the counter service. That's the activity where sales occur. From that point, we might have line weights, we have order accuracy, we have friendly scores. What different types of outputs do those inputs create? So here's an example for you on the inputs and outputs of claim process of an airline. Everybody loves baggage claim. Invariably, sooner or later, if you travel enough, you are going to have your baggage lost. So we have the baggage handler training, the time customers wait for return baggage, the maintenance of baggage handling equipment, the number of baggage handlers, the number of damaged bags, and on time flight performance. We're going to determine whether these are outputs or inputs for the baggage claim process. So for baggage handler training, where does that occur in the process? That's an input. It happens before the time customers wait for return baggage. Well, that would be an output because that is a result. The maintenance of the baggage handling equipment is another input. The number of baggage handlers, also an input. The number of damaged bags, that occurs at the end. That would be an output. On time flight performance, where does this fall? Well, that would be an input. We've come to the end of, no, we've come to the end of the slideshow. This is actually the end of the recording for chapter 22. I want you to go ahead and make sure you thoroughly read this. You will have a few homework assignments associated with this that we'll work on in class in the week following Thanksgiving. Please feel free to work on them ahead of time if you find that they are of enough ease. But if there's any that are tripping you up, let's bring those to class with you. Thank you and have a wonderful holiday.